You've definitely heard this phrase on the news, right? Especially when the economy starts looking a little shaky. The yield curve has inverted. It sounds so complicated, like some secret code only economists are supposed to know, but it's not. And today, we're going to decode it together.
So when a headline like this drops, the financial world kind of freaks out. Sometimes it's just a little bit of concern. Other times it's, full-on alarm bells ringing. But why? What is everyone so worried about? What does this even mean?
And that's the big question, isn't it? That's the mystery we're unpacking. What is this thing, and how did it get this crazy reputation for predicting the future? I'll give you a hint. It's not magic. And by the end of this, you'll see exactly why it gets so much attention.
Okay, before we can get why an inverted curve is such a big deal, we have to build a normal one first. And trust me, despite all the jargon, it really just comes down to a simple line on a graph.
So, the first piece of our puzzle is this word yield. It's really just a fancy financial term for the interest you earn. See, when you buy a government bond, you're basically just lending the government your money. The yield is simply the interest rate they promise to pay you for that loan. Simple as that.
Now, this all taps into an idea that we all get just on a gut level. If you lend a friend money for, say, a month, that feels way less risky than lending it to them for 10 years, right? I mean, a lot can happen in 10 years. So to make up for all that extra risk, you'd want a higher interest rate for the longer loan. It just makes sense.
And that super simple logic, longer loans get you higher interest, is what creates the shape of a normal, healthy yield curve. If you put it on a graph, you'd see the low interest rates for short loans on the left and the higher interest rates for long loans on the right. And boom, you get this nice upward sloping line. That's the sign of a healthy economy humming along.
But sometimes that simple, common sense logic gets flipped completely on its head. The graph literally turns upside down. And that is when economists and investors, they start paying very, very close attention.
And that is an inversion. All of a sudden, the market is telling us that a short-term loan is somehow riskier than a long-term one. The curve starts sloping downward, and it just breaks all the normal rules of risk and reward. To see just how weird this is, let's look at an example.
So imagine the yield on a 10-year government bond, that's a really long-term loan, is, say, 3.5%.
But then, at the exact same time, the yield on a much shorter, much safer 2-year bond is 4%. Now just think about that for a second. The market is offering to pay you more money for taking less risk. That just doesn't make any logical sense. And it's a huge red flag.
And here it is. This is why everyone panics. This isn't just some weird, quirky thing that happens on the markets. Historically, an inverted yield curve has shown up right before almost every single major U.S. recession. It is one of the most reliable warning signs we have, period.
So why does this even happen? It's not a glitch in the system or a mistake. It's actually driven by the collective psychology of thousands of investors, the smart money, and they're all making bets on what they think is going to happen next.
All right, so here's how it plays out step by step. First, it all starts with fear. Big-time investors start to think a recession is on its way. Second, they figure that if a recession hits, the central bank is going to have to cut interest rates to try and fix things. Third, to get ahead of the game, they all rush to buy long-term bonds right now so they can lock in today's higher rates for years to come. And finally, that huge stampede of people buying long-term bonds, it pushes their yields way down, even below the short-term yields. And there you have it. That's the inversion.
Okay, now this next part is really, really important to understand. An inverted yield curve doesn't cause a recession. It doesn't walk into a factory and shut it down. It doesn't fire anyone. It's a signal, not a cause. Honestly, the best way to think about it is like a thermometer. A thermometer can tell you that you have a fever, right? But the thermometer didn't give you the fever. It's just measuring it. In the same way, the inversion is just a measurement. It's a symptom of a widespread belief that the economy is about to get sick.
So what is that thermometer actually telling us? Well, it's signaling a few big things. It's investors betting that economic growth is going to slow down. It's a flashing light for a rising risk of recession. It also suggests that banks might start getting nervous and tighten up their lending, which makes it harder for businesses and for you to get a loan. And bottom line, it's the bond market saying it sees trouble on the horizon.
And that's really the message you should take away. When that curve inverts, it's the collective voice of one of the biggest, smartest, most forward-looking markets in the world, and it's sending a very clear, very loud warning, batten down the hatches.
So let's bring this all back home. The next time you see that headline pop up on your phone,
What should you remember? Well, now you'll know it's a whole lot more than just some boring financial jargon.
Because in the end, that's all the yield curve really is. It isn't a crystal ball predicting a certain future. It's a snapshot of our collective belief about the future. It's a graph of fear and expectation. And the only question it leaves us with is, this time, are they right?